The future is uncertain. It's a tautology, isn't it? We can never know with 100% certainty what the future is, but I'm sure many of us are feeling a lot of questioning of the market and where things are going, macroeconomically where things are going. But when we look at the facts, make solid predictions, and acknowledge the entire picture, the big picture, etc., I think we can make a pretty good understanding of where things are going to go and feel confident in our convictions. Now, we have chosen to refrain from making market decisions, predictions, broad market calls. We want to beat the market. We're not here to predict where the market goes unless there's a macro concern or event that we think will be positive or negative. That's, again, how this channel started. However, we're going to get a little macro today. And we're going to talk about the broader market and where things may go and what leads us in that direction. The first thing we're going to talk about is what Tom Lee, Fundstrat Tom Lee, is talking about regularly. I'm an FS Insight subscriber. Highly recommend it. If you've got, 25,000 plus, it probably will make mathematical sense. Anyways, what is he talking about? He's talking about a multi-year, possibly multi-decade bull run, and this isn't some delusional call. This is like the future is uncertain, a tautology of a call. So you have the wealthiest generation, the silent generation, baby boomers, etc., passing away. Fortunately or unfortunately, that's not the point of this video. We're looking at things objectively. Passing away and passing that wealth on to the next generation. Now, that generation had seen things like 15, 16, 17% US Treasury interest rates. The current generations that are going to be receiving that wealth have not seen anywhere close to that kind of bond yield. They are conditioned not only not to buy bonds and to buy stocks rather than bonds, but to not even trust the dollar. So you've got this chunk of wealth, which is currently being invested in a low risk way, relatively high exposure to bonds, going to people who have no interest in buying bonds. And it's not just low interest, it's no interest. I don't know anybody 35 or younger that I've met that has any interest in buying bonds. I don't even know one that has owned or purchased themselves a bond. I know many who purchase a whole lot of stocks. And the way it's been for years has been this notion of 60-40 kind of weighting, 60% stocks, 40% bonds, something like that, that's been dead. So the tautology is if we have wealth transferring, that wealth will need to be used. If the people who are using that wealth invest in a certain way, then the wealth will be used in a certain way. Or if the people who are receiving that wealth only invest in stocks or don't invest in bonds, then that wealth won't go to bonds. Therefore, obviously this is not 100%. I haven't thought about this logical proof and planned it out in a system, but therefore there will be less people buying bonds. And we all know what that means for a market. Prices go up, or prices go down, rather, yields will go up, etc. Overall, the stock market will benefit because instead of those dollars going to the bond market, which is actually bigger than the stock market, they will go to the stock market. And that will push prices up. However, that doesn't mean that we're not going to have economic issues. That doesn't mean anything except that people are going to buy more stocks. As a matter of fact, I'm not all, sunshine and rainbows here, okay? I'm not pessimistic either. You know, you look at the Apple Pro and just the Max chips, M1s. That's mind-blowing that they made those kinds of chips in such a short period of time. They just relatively recently started making chips, and all of a sudden they have like the best chips. So yeah, innovation is good. And honestly, it's not surprising. It's Apple, best computer company in the world. So we should expect that from them. But you got Tesla making their own chips. The productivity gains are going to be there. If you watch Ray Dalio's video called How the Economic Machine Works, you'll see productivity doesn't really change much. It's kind of just always upward sloping. And that's I expect that to continue. And I expect the market to continue to rally, but for the wrong reasons. I said Tom Lee's point on the wealth transfer. In my opinion, yes, that will certainly make the market run, but that's not a good thing. Like, that's not productivity gaining. That's not beneficial to anyone except us, which, you know, we're not trying to say, you know, it's got to be beneficial for kids in Africa. Okay? We're trying to benefit us here. This is what we do. But, you know, it's you would think that the stock market and output are correlated. However, I believe output can fall and the stock market can rise. And I think there's a whole lot of forces that may lead that to happen. One of which is population decline. Birth rates are declining. That is certainly not a good force. There's less people in the workforce, less people buying goods. That's a huge long-term issue, though, that we shouldn't worry about. Or we should worry about, but not be super pressed about. Another force, which we talk about quite frequently on this channel, is inflation, and we're seeing mining stocks do quite well today, and I would definitely add to those positions because they're down, many of which down quite significantly. I would add to those positions, in my opinion. Inflation is profound, and I'm starting to believe that this is going to be a lift all boats event. Apple is churning out the cash flow right now. I know I used to hate mega cap tech, and I still don't own them, but I don't think that rising bond yields deserves to obliterate them. So I'm kind of taking the foot off the gas with that mega cap tech bearish call. I personally don't own them. There's a lot better bangs for your buck, in my opinion, but we're seeing what Apple's doing. So inflation, not only are we, having supply chain bottlenecks, I think those are going to be resolved, okay? I think that's like the least of the inflation concerns. It's not the elephant in the room. There's a massive elephant in the room, and it actually has multiple parts, all intertwined. And it has nothing to necessarily even do with the money supply, although we'll talk about that in a second. It's the concentration and the concentration of wealth in the stock market and the stock market's incredible performance. I have learned today via CNBC in the morning that the wealthiest 1% control more than half the stocks, and the 10% control 89% of the stocks, and that is actually shifted to a greater favoring of the ultra acute wealthy. So the rich have gotten richer, and the poor have gotten a little bit richer, but the prices have gotten even more richer than the poor have gotten richer. So there's been a lot of clamoring about this rich getting richer issue, right? A whole lot of, we got to tax the rich. Even people who are rich are saying it's going to happen. So I think at some point it will happen, and it can only go on for so long. It's never lasted forever in history. It's always led to revolts, and we don't want that. So we're going to try and avoid that situation. And there will probably be some level of wealth distribution. I don't know. I'm not going to say what I think is best or what should happen with that. I'm talking macro today. I do see a wealth redistribution event on the horizon. Whether that be tax increases or infrastructure or both, it's going to occur. That means that, let's say it's infrastructure, and let's say it's taxes coming out for money that's not being spent. You give that to government spending and to the less wealthy, you give more money. You give more purchasing power. What do? They purchase more. What does that do? Increases prices. So, I think the wealth that has been accumulated at the top, that has obviously been astronomical. We've seen Elon Musk, not saying anything. I love Elon Musk, okay? I love space. I'm all about this stuff. Just trying to analyze the situation properly. Jeff Bezos, etc., getting very rich. There's a good chance that wealth, we talk about it, trickle down economics, it's got to trickle down. So once it trickles down, we should expect further inflation. Not supply chains, even though technically, yes, more buying, etc. But more purchasing power, more money in the hands of the people, and we'll see what happens with that. In addition, 40% money supply, that kind of might be lumped into this whole wealth redistribution phenomenon. We'll see what happens. I think inflation is a lift all boats event. Let's say supply chains are perfectly elastic and prices are always at their equilibrium, and wealth redistribution doesn't change price, companies will still be selling more goods. So there you go. They're going to make more money. Stocks go up. Even in an inflationary environment, nobody buys bonds, so nobody's competing for those bond versus long-term investment dollars. It could be a new paradigm. That's today's video. Energy is obviously still doing its thing. We talked a little bit about the mining stocks. We have those thoughts. Maybe we'll bring them up tomorrow. I just felt like I've been a little ambiguous with regards to market predictions and global macro. And I want to talk about that stuff too. So here we are laying out my views. We can get a little more in depth in this. I think this is a little convoluted. I don't take notes, don't write scripts. This is all off the cuff. I obviously am reading and listening to things all the time. But these videos, they're naked. They're naked. So that's the deal for today. Feel free to leave questions in the comments. Of course, I appreciate likes and subscriptions. So until next time, peace out. Have a good one.